Good morning and good welcome to the presentation of the first quarter 2023 results by the Photon Energy Group. My name is Georg Kota. I'm the CEO of Photon Energy, and today I'm joined by Emmeline Perry, our Head of Investor Relations and ESG.
Good morning.
And we will walk you today through the results of the first quarter. But before we start the presentation, I would also like to comment on news that we announced this morning, that Andrzej Horański, who came on board as our group CFO in early March, resigned for personal reasons, and as a result, the board has decided that I will be filling the group CFO role on an interim basis until we will have found a replacement, a new CFO, the process for which we will start in the next couple of days. So until we will have a new CFO identified and hired, I will be in charge of the financial agenda as well, which for me personally is a bit of a déjà vu, as I have held the position of CFO in the first 3 years of our company's existence, so since the formation in early 2008 until 2011. So clearly what is crucial here is maintaining continuity, and I believe that we'll be able to handle that. So today we will quickly run through our business model, the strategy, the financials, and the outlook for 2023. We'll start with the opening slide, and here I would like to hand over to Emmeline to walk you through some of the parameters.
Before we kick off, I would like to remind you that you can submit questions anytime during the session through the chat box, which is available on the platform. And there will be a Q&A session at the end of the presentation. So let's start with a general overview of the company. Photon Energy Group was founded in 2008, 15 years ago, headquartered in Amsterdam, with most of the corporate structure in Prague, in the Czech Republic, where we started our activities and where we have our first power plants built. The company is experiencing a high growth, and we now have more than 320 employees. We're active in 10 countries, mostly in Central Europe, with another base down under in Australia, as the company was founded by George, sitting next to me, and by Michael Gartner, who is an Australian national. Our shares are traded on the regulated market of the Warsaw Stock Exchange and of the Prague Stock Exchange, and our shares are also tradable on the quotation board of the Frankfurt Stock Exchange in euros. Currently, 3 research houses are covering the stock, one in the Czech Republic, one in Germany, and one in Poland. And we're very happy to have recently received the renewal of a very good ESG rating from Immigrating, which is one of the leading sustainability rating agencies in Germany, and a specialized boutique in ESG research. We're very focused on sustainability, that we see as a key driver of value creation for our company, and we're getting prepared for the upcoming reporting requirements related to the ESRS, the European standard, which is coming in terms of sustainability. George, do you want to
Yes, thank you, Emmeline. So I think for us, just to comment on the ESG rating, obviously our business scores relatively high on the E, but of course the S and G are just as important. And I think that the renewal, where we managed to increase our rating by 1 point, shows that we are taking this agenda seriously, and will do so going forward. And as you know, we have issued a green bond. So for us, also from an access to financing point of view, this rating is of great importance. So just a few highlights and KPIs on our business lines. So in the solar business line, we have managed to further increase our project pipeline to 940 megawatts. We now stand at over 130 megawatts constructed, the vast majority of that for our proprietary portfolio, which after the recent commissionings in Romania has first gone through the barrier of 100 megawatts, which of course for us is an important milestone, and we currently stand at 113.1 megawatts, where another 10.3 megawatts, 2 additional power plants, are waiting for commissioning. So they are essentially the construction is finished. We are just sorting out the grid connection and commissioning topics with the DSO, and that should happen in the next few weeks, which would then conclude the commissioning of our entire first batch of power plants, as we refer to it internally, of in total 31.5 megawatts. So this has not only led to an increase in our portfolio, but also further diversified our portfolio by adding a new jurisdiction, in this case, Romania. In 2022, we generated 121.6 gigawatt hours of electricity, and of course for this year, based on the growth in installed capacity, we expect also significant growth in generated volumes. And in our operations and maintenance division, we have grown to 430 megawatts. So there is, after a few years where we've been relatively stable, that's already noticeable growth. And what we do see is an increased level in demand for our O&M services, particularly across the CE region, where today, and we can rightly claim that we are the only operational and maintenance organization that covers the CE region, 5 countries: Poland, Czech Republic, Slovakia, Hungary, and Romania, with people on the ground and servicing both owned but also third-party owned assets. So in this business line, we are very hopeful to see, very confident that we'll see accelerating growth in the next couple of quarters and years. Then the highlights or the key KPIs for Lerta, which we acquired at the end of last year, are that in the virtual power plant we have around 290 megawatts of capacity aggregated, and in the Polish capacity market we have contracted demand side response services with the Polish transmission system operator of 134 megawatts this year. In March, we were successful in winning an additional 375 megawatts of DSR services for 2024. This comes on top of 14 megawatts that were already previously contracted. So for next year, that will be we'll have 389 megawatts of DSR services we'll be providing to the Polish TSO, and as already announced in December, in the auction in the main auction for the year 2027, we also managed to win and contract 157 megawatts for 2027. In March 2026 will be the additional auction where we then expect to contract significantly more capacity with the Polish TSO. Then, of course, we have our water business line, where I will be, when we get to it further down, provide you with an update on our PFAS opportunity in particular. So, as mentioned before, our project pipeline keeps growing as we add new opportunities, particularly in the CE region. So we stand at now 940 megawatt peak, with a particular focus on Hungary, Poland, and Romania, as well as Australia. I've already spoken about our portfolio of power plants, which now stands at 113, and in the next couple of weeks will grow to 123.5 megawatts. In the next couple of days or very few weeks, we will also be able to announce the start of construction on the next batch of projects that have reached the ready-to-build stage, and that will be turning into operating power plants, some of which we still expect to commission this year, and some in the first quarter of next year. So there'll be an additional growth, provide additional growth to our portfolio in the Romanian market. So those projects have a planned installed capacity of 38.5 megawatts, which, once connected, would take our installed base in Romania to approximately 70 megawatts. And as you can later see from our project pipeline, this is not where our plans for the Romanian market end. So there'll be then quite a few more projects for 2024 and beyond that we intend to realize. On O&M, we have managed to grow in the last couple of months from around 300 megawatts to 380, and on top of that, we have around 50 megawatts of specialized services we provide for PV inverters. I've spoken about the capacity market already. So we do see growth opportunities across all our business lines, and we are, of course, dedicated to realize them. So the next slide is dedicated to our strategy, where this is a slide we have already presented earlier this year. So just very quickly and just as a reminder, so at the end of last year, we completed the acquisition of Lerta, where in the first step we bought out the other financial investors. Photon Energy, having been a financial investor after two financing rounds where we participated, we were holding 24%. We bought out three financial investors that had come during the private equity or venture capital / private equity financing phase of Lerta on board, and before the end of the year, we agreed with the two founders of Lerta in the acquisition of their shares, where the vast majority of the consideration was in the form of Photon Energy shares. So both founders have a continued interest in the well-being of the now combined group, which for us is of course of extreme importance. And what maybe if you can move to the next slide. The key essence of this transaction is that it has taken our business model, which was on the solar side is fully integrated, and we're covering the life cycle of solar assets, and based on our strategy of selling electricity from our power plants on a merchant basis, that means into the electricity market, and that's where kind of our engagement with the market used to end. Now we have, through the integration of Lerta, I would say entered the very exciting and dynamic developments in the energy market, where we see many trends now coming together. One that has been, of course, ongoing for a long time, and that is the democratization of energy generation. So clearly, as more and more renewable power plants are being installed, that's utility scale, but of course now with more and more behind the meter installations, ranging from retail all the way to industrial users. There's a lot. The number of generation sources has and continues growing very dynamically. At the same time, we also see that the needs and the approach of energy users is changing again in all segments, all the way from households to industrial users. Here, one key driver being the growing demand and interest in consuming renewable energy. That means green energy. But at the same time as renewable energy sources, which by definition are intermittent, it means that their production depends on the weather, the sunshine or wind, as solar and wind are the account for the vast majority of newly added capacity. This, of course, is leading to, well, at the same time, we also see the retirement of baseload assets. Most recently, the shutdown of the last 3 remaining nuclear power plants in Germany. But of course, there is a very similar development with coal-fired generation, which will actually accelerate in the next couple of years and over the next 2 decades. Not only in Europe, but the same applies to Australia and other markets in the world. So as this energy supply mix is changing, this is creating very significant issues for the distribution system operators and the transmission system operators across the world, and a significant increase in flexibility on the supply side, but also the demand side is emerging. And so on the supply side, there is so the significant part of all the flexible sources these days is not only used rarely, as it used to be the case, but actually deployed very regularly. What is coming into the mix, although very slowly, is energy storage, which allows can play longer term a significant role in balancing the grid. But the deployment there is not going as fast as some would anticipate. But we do expect a significant acceleration on that front, and we also want to be part of that. But one service that is getting a lot of attention and is more and more coming to the forefront as a quick response to this growing imbalance in the grid, or as a mean how to address it, is demand side response, and which in essence is the aggregation of a large number of energy users that, if demanded by the grid operator, can and are willing to reduce their demand, in some cases drastically. And by aggregating a large number of these energy users, a significant positive contribution to the balance in the grid can be achieved, not by producing more electricity, but by reducing the demand in a coordinated and timely manner. And Poland has been at the forefront of this through their capacity market mechanism, and this is where Lerta, before acquisition and now after acquisition, the success in the auction for 2024 proves that is well positioned to play an ever more significant role. A key element for the service is the virtual power plant, which is essentially a very sophisticated software that allows the coordination of this demand side response if and when required by the transmission system operator. What we are observing today is that in a truly rapidly growing number of countries, the transmission system operators, in some cases the regulators, are establishing mechanisms, market-based mechanisms, to procure flexibility services, including demand-side response. So the most recent ones in Europe are Spain, Ireland, Italy, but we are Ireland, Italy, but we're observing early stages of that process also in other markets. In Australia, this is now a fast emerging topic. Here, it maybe makes sense to point out that the UK was the first country that created this mechanism. Poland then followed, and to a large degree copied the model. And coming back to Australia, in Australia they are also now very closely looking and working on integrating that concept into the Australian market. But globally, there is a very strong trend into this because the need to digest this change in the energy mix is very significant, and the problem is accelerating. So demand side response on the basis of our virtual power plant will allow us to address markets where we find the market conditions, the regulatory framework attractive to enter these markets quickly and also at a modest additional investment. The ultimate goal for us from combining the original Photon Energy business model and Lerta's business model is to become a sophisticated partner for energy users, where the primary focus is on commercial and industrial customers, and help them in their response to new market realities, which are that energy prices have been going up. Now we've seen a bit of a calming of the situation, but longer term, I think it is clear that energy prices will not go back to the levels we were used to until 2 years ago. Also the way energy is procured is changing. So many energy traders are not so keen anymore to provide fixed price contracts. So energy prices are variable. Many energy users have found themselves, in some cases overnight, in the day-ahead market. So they had to buy electricity. When we look at Australia, where energy is traded in a spot market in 5-minute intervals, we can see that a lot of energy users, also commercial industrial, are actually procuring their electricity through the spot market, and in order to and they're developing mechanisms and strategies how to benefit from that. And one of those steps is to install, for example, a PV system on their roof or somewhere near the consumption point. Adding a battery is becoming very quickly becoming a viable option, which has the additional benefits. But what we also see is that a lot of these customers are working very hard on increasing the flexibility of their energy consumption, which then in itself has value that can be monetized, for example, through a demand side response service provided to the TSO, but there are also other mechanisms, particularly when there's a battery in the equation. So it's of course for an energy user who has been used to signing a fixed price contract and not worry where the electricity came from. This is a very significant leap and requires a lot of understanding or learning new things about how the energy market works, and we can see that already positioning ourselves now very well as a partner to energy users in this journey. And of course, the fact that we can also supply those energy users with green electricity is an added benefit. So a few words of update on our investment and development based on the reagent technology. So we invested in 2 financing rounds into Radiant Technologies, which is an Australian-based technology company that has developed a new approach to concentrated solar. As you can see on the description below, what is new about the technology is that the concentrated sunlight, which in other CSP approaches gets harvested by storing the heat. In the case of Radiant, they have developed a photovoltaic cell that can be placed in that receiver, and as opposed to traditional PV cells, which actually don't like even warm weather, let alone 700 degrees, as in this case, can withstand the temperature, so that this concentrated sunlight gets actually used twice, instantly to generate electricity from the PV cells, while the heat still gets captured. And the second element is the way this heat gets stored. With traditional CSP technologies, this is very often in some special oils or in salt, whereas here the heat is reduced and stored in water. So this power plant has two hyper-insulated water reservoirs, and in the hot water pool or hot water reservoir, water is kept just below the boiling point, so between 90 and 95 degrees. And all or part of the PV generated electricity is used to chill water in the second reservoir to just above the freezing point, so typically around 5 degrees Celsius. And when electricity is needed through an organic Rankine cycle engine, which is commonly used also in geothermal power plants, electricity is produced and can be supplied either to the grid, or the system can also run as an island and supply, for example, a remote mining operation or a remote settlement. And if connected to the grid, it can not only provide electricity, but also grid support services to help stabilize the grid. And the Radiant concept allows to completely separate the generation profile from the supply profile. So it is possible to clearly, energy is only generated during the day when the sun shines, but the supply to the grid can be a 24-hour stable baseload. It can be just focused on demand peaks, or it could, for example, supply electricity only at night when, for example, PV generated electricity is not available. So we invested in this company in 2 rounds. We currently hold a 7.5% equity stake. In the last financing round, we were joined by some major corporates, including Chevron, Schlumberger, Equinor, and AGL, the largest utility in Australia. And we are currently developing our first project on the basis of the Radiant technology in South Australia, which is planned to have a generation capacity of about 300 megawatts and a storage capacity of 3.6 gigawatt hours, which today would make it the largest energy storage project in the world besides pumped hydro. So on this project, we are working hard on the permitting, and we will also soon commence to work on securing the financing and getting it to financial close. Radiant is now on the finishing line of commissioning the first full-scale pilot plant, including storage, which is a 4 megawatt generation and 50 megawatt hour storage project in Australia, and that commissioning should also happen in the next couple of weeks. And of course, showing an operating system will also be very important for us as we work on the financing. We are looking for additional project opportunities in Australia, and we've also commenced the same process in South Africa, where we've identified one suitable plot of land and we're reviewing others. So this is a technology that we very strongly believe in, and not only us, but also the corporate investors that have come in the last financing round. And I think the picture is getting clearer that at this point in time, this technology promises to provide the lowest levelized cost of energy, including storage, from a renewable energy source worldwide. However, it is important to point out that reagent plants need a certain minimum level of direct solar radiation. So it's not suitable for all geographies, but there's about 50 to 60 countries in the world where reagent power plants will be viable and good investments. Coming to the financials. So the highlights for the first quarter were that we legally completed the acquisition of Lerta. The transaction with one of the two founders was slightly delayed for structuring reasons. So it was only completed in Q1, taking us legally to 100% as of February 1st. Then in the first quarter still, we managed to commission our first power plant in Romania in a location called Siria, with an installed capacity of 5.7 megawatts. This was the first utility scale PV power plant commissioned in Romania since 2014, when the first solar boom in Romania came to an unhappy halt. And since then, we have commissioned 5 more power plants with a capacity of 15.5, the last of which we commissioned just a few days ago in Aiud and Teuș. Also, very importantly, we managed to secure, sign, and draw down project refinancing for these 6 power plants plus the 2 that we are planning to commission in the next couple of weeks, with a total volume of nearly 22 million euros. And what makes this special is that this is for us, but we believe also in the region, the first, and if not at least the very, very first project financing for a renewable energy source that whose revenue model is based on the merchant approach, basically selling into the market without a power purchase agreement. The financing has been provided by Raiffeisen Bank International in euros, as also the revenues are euro linked, given that electricity is traded in euros. So this is a major milestone for us. We also believe for the renewable energy sector in Europe and in Romania in particular. So not only did we commission the first new power plants after a very long time in Romania, but we've also concluded the financing that I think is a very strong signal for the Romanian renewable energy sector. So then, as already mentioned before, the capacity auction for 2024 was very successful, and through this mechanism, we've been able to contract revenues of nearly 25 million euros with the Polish transmission system operators for 2024. I think we've also announced that we see a lot of further growth potential. Even before this auction actually has taken us on a higher growth trajectory than before. So the goal is to get to 1 gigawatt by 2030 in terms of DSR services provided to the Polish transmission system operator. On the financing side, during the first quarter, we did a small tap on our green bond, essentially rounding up the outstanding nominal by 2.5 million to a total of 80 million euros. Of course, the conditions in the fixed income market due to the rising interest rates, but in Germany, particularly also due to some of the issues in this SME bond segment, where our bonds are essentially part of. Some issues have some of them have actually gone into insolvency or failed to repay their bonds in time. So rather difficult general situation. So even despite that, we have been able to place additional bonds with investors, which just shows that today I think we can rightly claim we are considered to be one of the reliable issuers in that segment. And as Emmeline already pointed out earlier, we only yesterday received the renewal of our ESG rating as a result of very good by EMOG rating. So this is the renewal after 2 years. So we did the first rating 2 years ago, and this has been renewed now. So looking at our portfolio and energy generation, the first quarter has been a rather difficult one in terms of production volume. So the weather conditions throughout the entire first quarter led to generation results in each of the 3 months below our forecast. So in total, we were 10% below our expected volume. Of course, plus we have essentially experienced a delay in the commissioning of our power plants. However, in the first quarter we did commission Sheria, but only in March. So therefore, the contribution of our Hungarian portfolio has been very small. In our original budgeting for this year, we expect a more significant contribution in terms of volume. But as these assets now come online, they will contribute very, very significantly. So when we look at compare with last year and the year before, so last year we had a significant increase in energy generation from 15 to 1 gigawatt in the first quarter of 2021 to 26.7, which was driven by an increase in installed capacity. But there, the main contributor being our 2 power plants in Australia that we commissioned in August 21. But this year we have seen a reduction. But what is also important is that we have changed the revenue composition. And last year, in the first quarter, we were already in the merchant model with our Australian power plants plus the Czech portfolio, but not yet with our Hungarian portfolio. There we exited the feed-in tariff mechanism as of April 1st, so the very next day. And of course, we are still outside that mechanism. We have the right to return if conditions would worsen, but that's something we do not foresee at this point in time. But as you can see, the share of electricity generation that gets sold in the market at market prices has grown significantly year on year. The portfolio, I think we have spoken about the growth already. So that will continue now with the next 2 power plants. And with respect to the composition, merchant, so the business models. Sorry, if you could go back, please. So in the Czech Republic for this year, we continued last year's approach. So we went into the green bonus scheme, where the green bonus is essentially the subsidy element related to the investment into the power plants in 2009 and 10, and electricity, which we still maintain ownership of. We are selling into the market. In Hungary, we have gone largely merchant, and just a very small proportion of our installed capacity remained in the feed-in tariff system or in a contract for difference scheme. In Australia, our leading projects are merchant. Now, our Romanian assets from the get-go are merchant. In Slovakia, our 10.5 megawatts are in the feed-in tariff scheme, so there's no exit option, or for example, a similar scheme as in the Czech Republic, where we can would have a green bonus and be able to sell electricity. And and in Australia, we have one small installation that is generating revenues on the basis of a feed-in tariff, however, not really material. So moving on to our financial results for the first quarter. The top line is providing a very encouraging picture, and this growth is driven by increases in revenues in our components trading business. So the start into this year, so last year we saw a relatively slow start and then very strong accelerating growth during the year. So this year we have managed to generate significant revenues also in the first quarter, despite the fact that the market overall has been rather slow, but we still managed to grow our revenues significantly year on year. We have seen encouraging growth in our EPC business for external customers in Australia. And then, of course, on the back of the acquisition of Lerta, for the first time, we had demand-side response revenues from the capacity market, so from the Polish TSO, where for this year, as mentioned before, we have contracted 134 megawatts. The annual revenues from these 134 megawatts are 7.7 million, and in the first quarter we generated actually more than a quarter of that, so slightly above 2 million euros, as the prices for DSR in the first and the fourth quarter are higher than in the second and the third. So and also looking ahead, next year with the 389 annual revenues of 24.8 compared to the 7.7 for this year. What we can clearly see here is DSR revenues, and further down the road, revenues from other flexibility and grid support services will very quickly emerge as an additional pillar of contracted and stable revenues, and next to what to date has been the mainstay, which have been our electricity sales revenues. So these were the main contributors to the increase in revenues, which we of course see as an encouraging sign. However, drilling further down into the numbers, we have stayed behind on revenues from energy generation, where against our budget we've been around 2 million euros below budget, and that is a combination of the lower volume due to the weather, which we as mentioned before, also lower energy prices compared to our budget at the end of last year, and also the delay in getting our Romanian power plants commissioned, which we in our budgeting expected to contribute already to a significant degree in the first quarter. And given the fact that the energy generation revenues come with a very high EBITDA margin, this effect, of course, feds through the P&L. In addition, we had one-off costs related to the acquisition of Lerta, to the tune of around 500,000 euros that we booked in the first quarter. And at the same time, we are investing heavily into our business development, with a particular focus on the new business lines that came to us through the integration of Lerta. So that is DSR services expansion to other countries. It's related to origination and trading in the countries where Lerta has a physical presence and energy trading licenses. And we're also working on developing this business in the Australian market. So we are currently working on obtaining an energy trading license in the Australian market, and we want to launch on the back of that also then additional services, including DSR, as soon as the mechanism is available. And there's so we're in the process of hiring a team, a very experienced team. But of course, before we start our operations, what we're incurring are costs, which are also reflected in our Q1 numbers. Of course, in the positive contribution from these new activities or the expansion of these activities will be visible further down the road. Excuse me, please. So to sum up, we have seen significant growth in our revenues, where the composition of these revenues in terms of their margin is fundamentally different than last year. So on that basis, we have seen a reduction in our EBITDA from 2 million last year to 330,000. I think so far, so I can say that our budget was foreseeing an increase compared to last year, but the effects I described before led to this current picture. And then on the EBIT level, of course, as a result, we swung from 500,000 profit to a 1.5 million loss, and that fed all the way to the bottom line. On the other hand, we have recorded other comprehensive income of 2.5 million. So at the total comprehensive income level, we are at a minus of 1.6 million. So in the other comprehensive income, we had a positive effect related to
connection with
to the revaluation of our Romanian project, our first power plant in Syria, and the reclassification of tax shields. So I think to sum up, it is probably not a dream start into this year. However, it is important to bear in mind that the first quarter has always been our weakest quarter in terms of revenues and profitability. Here we had several factors aligning that have led to this decline, but it is early days. What we do see as encouraging is that, and that is reflected in the top line, that other business lines are now contributing more strongly, like for example our EPC business in Australia, but so do the new business lines that came to us through the integration of Lerta. On the balance sheet, during the first quarter, we have seen an increase in our fixed assets related to the commissioning of power plants in Romania, and also our total balance sheet has grown from 254 million to nearly 270. We had, despite the negative total comprehensive income, an increase in our equity related to the issuance of new shares in relation to the acquisition of Lerta. Our long-term liabilities have increased by 2.5 million through the issuance of the bond. And here maybe I would like to speak a little bit about our financing mix. Today, all our financial debt is in the form of the bond, which has a maturity in 2027, or project level financing. And what we've done last year is on the project level financing, make sure that all our financial debt is in relation to the interest rates fully hedged. So until I would say the middle of last year, before it became obvious that interest rates are going up on the back of growing inflation, we did keep a certain percentage, so between 30 and 40% typically, of our financial exposure unhedged. But as we saw this development, we hedged all of our financial debt. So this today is very important. So the bond is a fixed coupon bond. All the interest rate exposure on our project level debt is fully hedged. So a further increase in interest rates, of course, has an impact on the cost of new financing. It also has an impact, of course, on the cost of accessing the bond market, but it has no impact on our existing financial debt. And what we, after I would say a very long time, for many years, we have added a bank financing line for Photon Energy Technology, which is our component distribution business, where we have signed a 5 million overdraft facility, a working capital line with UniCredit Bank in the Czech Republic, and that line is being used to optimize the working capital requirement by this division to the group cash flow or cash pool, and yeah, simply gives us higher flexibility as we are growing this business line, where sometimes it is necessary to run at higher stock levels, and this is easing the pressure on our central cash pool. So on the operating cash flow, here we can see that we came in at minus 2.4 million compared to 6.5. What is important to point out here is that, and that actually relates also to the first quarter last year, where 6.5 million minus looks like a very significant number. Also this year, what is significantly impacting this operating cash flow is actually the procurement activities related to the construction of our power plants. So in order to speed up the process, we are procuring certain components either at ready to build or in some cases even slightly earlier, like for example transformers, where we know that the delivery times are very long. We've also resorted to a similar approach with some other components, particularly mounting structures, in order to be able, for example, as we place larger orders, we get better pricing. In Q1 last year, we actually accelerated the procurement of mounting structures in order to fix a price, because as some of you may remember back then, commodity prices were literally yo-yo, and prices changed really dramatically on a daily basis. So the procurement process for the construction of our power plants has a significant impact. I think in the detailed financials you can see that impact. The investment cash flow, again, we already started investing in the first quarter. The financial cash flow is basically reflects the increase in our outstanding bond. So the net change in cash for the first quarter was negative 2.6 million, leaving us with a cash position of, well, an available cash position of 8.6 million euros. After the end of the quarter, we signed and drew down the refinancing facility with Raiffeisen Bank International, which to the tune of 21.9 million euros. So that cash position very quickly after jumped significantly, close to 30 million euros. So at the end of the first quarter, where we had the entire construction of these 31.5 megawatts in Romania financed from our own internal resources. So this was a temporary low point, and the cash position today is again significantly higher. So with respect to the outlook, we published together with the publication of our audited results, we provided guidance for this year. This is the second time we're doing it. We did it the first time last year, where the guidance as a projection for consolidated revenues of 150 million euros, which would represent an increase of close to 60% over the 95 million generated in 2022, which in itself was a very significant growth compared to 2021. We are also expecting or forecasting an increase in our EBITDA, which came in at 24.3 million last year to 29 million this year. Of course, now looking at the Q1 numbers, there may be some open questions, but as I said, we had several factors coming together, and I think on the generation volume, which literally and truly was very low in the first quarter. When we look at our operating history, we haven't recorded a year where all 12 months were below forecast. So we believe that this will balance out over the year in terms of volume, in terms of market prices. The average market prices that we'll achieve this year are highly likely to be below last year's. However, we have a significantly higher installed base that has come online already. So now as we're entering the strong months of the year, we will have 30 megawatts more, or 31.5 megawatts more of generation capacity. So we believe that this volume increase will make up for the difference. And as I mentioned before, we see very positive dynamics in the other business lines, and plus the new business lines that came to us or become part of our revenue mix through the integration of Lerta. So at this point in time, we are maintaining our guidance for this year. However, there are a lot of moving factors which we appreciate, and I think that when we publish the half year results in mid-August, we will clearly have a better picture of the direction of travel. But at this point in time, we are sticking to our guidance for this year.
Okay, I think we're done with the slides for now, so we can kick off the.
Well, I would, before we come to answering the questions, this time we did not have a slide on our photovoltaic activities and our remediation technology. But what I'd like to point out is, as we have published in the past, we have had an ongoing trial with the Australian Department of Defence, where our in situ nano-remediation technology was tested on one of the Australian Department of Defence's Air Force bases to see the efficiency of our technology in degrading PFAS chemicals. PFAS chemicals have now, also referred to as the forever chemicals, have now also here in Europe come to the forefront. It actually happened in Q1 in late February. Le Monde and 17 other media outlets came with a very detailed and well-researched, not article, but actually report about the size of the problem of PFAS contamination, PFAS chemical contamination in Europe, where over 21,000 sites were identified, and plus a similar number of suspected sites of PFAS contamination, with Germany, Benelux, Denmark, UK, and parts of Italy being particularly hotspots. So this is very quickly coming to the forefront, as a major environmental hazard. So we are currently at the stage where our pilot project has been completed, and we are in the process of completing the final report, which we're submitting to the Australian Department of Defence. Based on our reading of the results, we believe that we'll be talking about PFAS and our remediation technology more often and more intensively in our communication with the market. So as this trial has been going on for 2.5 years and got delayed, well, the trial itself took 6 months. Now with some additional measurement, 8 months. However, the whole process took 2.5 years, which was due to COVID, travel restrictions, and other unforeseen matters. But this trial has now been completed, and from our point of view, successfully. Let's move to questions.
So I guess this has answered the questions related to the contribution of the water treatment activities. But maybe we can kick off with
we'll start. So we'll do it one by one. So the question is whether we plan to distribute company's earnings as dividends to shareholders. Well, our approach to dividends is, I would say, is dictated by finance theory, which says that if a company can reinvest its earnings at a higher return than its cost of capital, it should do so. If not, it should return it to its investors across equity and debt holders. So as we believe that we are in possession or to have available to us investment opportunity that provide us higher returns, we at this point in time do not foresee the distribution of dividends. But what will guide our approach to this question going forward is exactly what I just outlined. So clearly, if our growth opportunities or investment opportunities don't provide an attractive return, then that capital will definitely be returned to investors, and that may take various forms. I think here it's also important to point out that we are currently conducting a share buyback program, and that is related to our employee share purchase program, which we have feeding from our treasury shares, and in order to replenish our treasury shares for this purpose, we are conducting a share repurchase program of 250,000 shares, where we have now already completed more than 2/3 of that buyback. So if any buyback is a return of capital to shareholders, so that is actually happening. However, it is related to so it's not part of a necessarily, or it's not primarily driven by a distribution policy, but as part of the share purchase program for employees.
Okay, so one question related to the new energy division, which was break-even in Q1, coming from Olivier.
Yes, so new energy was roughly break-even in Q1. So if we strip out the internal revenues, essentially would that change the picture, and then what are the EBITDA margins? Well, yes, there are. So I can confirm there are revenues, internal revenues, as Lerta is, or New Energy is selling our electricity in the Czech Republic and Hungary from our power plants to the market. So the volumes there are financially quite significant. So, however, the margin on that is very low, and also the fee that we're paying for that service, or let's say our asset management or our power plants are paying for that service, are actually very low. So I think in Q1 it could even be argued that Lerta didn't even make money on that, or on the new energy division. So revenue, yes, but the picture, the EBITDA number that is in our segment reporting would not be impacted if the EBITDA number would not be impacted by stripping out our group internal activities. And for the EBITDA margins for this year and 24, we are currently in the process of revising. And again, as we are investing quite significantly into these business activities, and one area that I mentioned before is actually the new energy activities in Australia, but also in the region. Of course, what we have is that investment through OPEX effect. So I think it's very difficult to completely and directly estimate the margins because we have this effect, and it is currently quite significant.
So that question about the annual guidance, do you plan to revise downwards the annual guidance after 1Q23?
So I think we answered it already, but basically the answer is no. But of course, we as the market moves on, the year moves on, and here I think, I mean, looking back to last year, which again for us was the first year where we provided the guidance, we did revise our guidance together with the publication of our half year results. In that case, it was upwards, and our upward revision proved to be quite accurate. So I think that will be the moment, I mean, unless something fundamental is a really strong reason where we will have a clear picture earlier that we need to change our guidance. This for us is now the next milestone where we foresee to comment again on our forecast or guidance.
All right, so that question is related to the resignation of our CFO.
Yes.
That you commented at the beginning of the meeting.
Yes. So why the second CFO resigned? So, well, I think when we communicated the departure of Clemens Wormuth, who had been with us for an extensive period of time, so over 10 years, this basically was a decision taken by him. We have of course, it was also discussed and prepared. I think that after the CFO leaving or any executive leaving after 10 years is a relatively normal situation. In the case of Andrzej Horansky resigning after 2 months, it is very unfortunate. As we stated, it is for personal reasons, on which I am not at liberty of providing more details. It is, of course, unfortunate in this with the sequence of events, but these things happen. And now, as this comes as a surprise, as opposed to the situation with Clemens Wormuth earlier, of course, we need to. It will take us some time, and we actually do want to take the time to find the right candidate. So as this happened as a surprise, of course, it's necessary to maintain continuity, and so the quick fix for us is that I stepped in, not least on the basis of the fact that I held this position in the first 3 years of our company's history, and given our also the quality of our finance and accounting department, I believe that we will be able to maintain that continuity without any major issues. Looking at my work-life balance, of course, 2 roles is not something it's not like I've chosen this. It's not like I would want to do that for an extended period of time. But and of course, we are interested in filling this role with the right candidate as soon as possible. But we will take our time. We need to. So as before, we have had a CFO for over 10 years, and if you look at the rest of the board, I think our history is one of stability, and clearly whoever comes on board as CFO at the end of this process, we of course hope and expect to have on board for an extended period of time. So I think we don't have a history of a revolving door policy at the board level. As I said, this sequence of events now is unfortunate, but I think in our history, when I think back at retroactive measures taken by various governments, this is a really minor issue, and I think we are internally strong enough in terms of team and processes to overcome this period, which should not take more than a few months, even if until we identify a candidate and such a chosen candidate can join us.
Next question is related to increased personnel costs.
Yes, so we had more than double of people-related costs. I mean, and whether we plan to optimize. I mean, of course, we have now, before the acquisition of Lerta, we have had quite a dynamic development in our headcount. The acquisition of Lerta has fueled that further. I mean, with that increased number of people has also come a business including many additional business lines, or some additional business lines. And I would say now across the board in all our business lines, we do see and we do work hard to realize the growth opportunities. So this is why we are adding, have been adding, and to a certain extent will keep adding people. But, and I think this is what this alludes to, we do not want to do that blindly. So as we add, we of course are looking very closely at the impact on our company's finances, where in some activities, so for example, when you add salespeople, the results have to come very quickly. When we look at for example, now the process we've started in Australia in building up the energy supply and the fully integrated energy solution business in Australia. So it takes some time. So, and it's also quite a significant investment. The entire process of getting the applying and receiving the energy trading license. Before you actually get it, you have to show that you have a team in place. Compliance is very strict in Australia, so there's an upfront investment, and this is what's happening. It goes through the P&L, and then of course that business also has a growth trajectory. But the fact that we're doing it means we very strongly believe in this in the market opportunity, also in the Australian business. But we're doing the same also now in our markets here in Central Europe. So it is definitely a moment where we need to be on the watch, and I think and we have to be, and we will be prepared to take action, or as formulated in the question, optimize our approach. So it's definitely not about empire building, and so we're not trying to maximize the number of employees. Every addition to headcount has to have a positive effect to the overall financial picture of our company. However, in certain areas, that question is answered faster. In others, it takes some time.
Okay, next question.
So the radiant technology, what is the
cost and percentage of energy loss due to storage?
Oh, okay. Well, what I'm aware of is that these hot water pits have been used, are still being used also in district or local district heating concepts in Denmark, for example. So there's an installed base of these hyper-insulated reservoirs where heat is stored during the summer and then used in winter, so over 6 months. And my understanding is that the heat loss in that period is somewhere around 10%, maybe slightly lower or higher. So in other words, that's why I'm using the word hyper-insulated. So the losses are very small. Of course, in the case of reagent, the storage time is not 6 months, but significantly shorter. So this should actually not really play a major role. So there are no. When do you expect the water division to pick up the pace and start contributing to the top and bottom line? Well, it is true that the water division remains still relatively small in comparison to the overall picture. We have essentially 4 business lines, one of which is the nano-remediation. The other ones are related to lake management, water purification equipment, and services provided to water utilities. So in all of these, the last 3, we see growth, but not the explosive ones. So, but that we believe is possible with the nano-remediation. And this is why at the end of the presentation I refer to our pilot project in Australia, which if the results confirm that our technology can effectively and efficiently degrade PFAS chemicals in an in situ approach, either in water or in soil, then a very, very significant global market opens up to us. And I think so much I can say that the Australian Department of Defence is not a research institution, but it's an organization that has a massive problem with PFAS contamination, mostly, but not only on the Air Force bases. They are being sued in multiple cases by the residents living around those Air Force bases. In some cases, the Department of Defence has even had to pay compensation in the hundreds of millions of Australian dollars. Essentially, the same situation applies to the operator of civil airports in Australia and also firefighting organizations. So the source of contamination here being firefighting foams laced with PFAS chemicals that have been sprayed for decades. So clearly, if there's going to be a success in the pilot and the efficiency is going to be confirmed, we would expect that the Department of Defense would be interested in continuing and expanding that cooperation. And given how visible a party Australian Department of Defense is in terms of PFAS contamination, I think it's fair to say that there are other entities, some of which I referred to just before, are closely watching the results of this pilot project. So, and of course, our colleagues in Australia are talking to them, but that is only Australia. I mean, Australia is a market that has been at the forefront of recognizing this threat, of having regulatory pressure to tackle the problem of PFAS contamination due to the suspected impact on human health. And so it is a significant market in itself, but the opportunity is global. So North America is a much bigger market. The US Air Force has 800 known Air Force bases with very significant PFAS contamination. Back in 2019, the Pentagon actually created a $2.1 billion fund to find solutions to PFAS contamination. And I think now in the meantime, across the Western world, you can say the maximum limits for PFAS chemicals in drinking water, in food, and the human intake per day have been continuously being lowered. So it is a topic that's at the forefront. And I think now there's even legislation that has been passed in the US that is compelling actually the Air Force, but also other organizations that have been the source of contamination to clean it up. So very, very significant market opportunity, and so I think we are at the point where our technology will have measurable results, and I think so much we can say we are working very hard to prepare ourselves for addressing it.
Just we have another 10 minutes.
Yes, so we open that to the prosumers market, or keep it B2B oriented. Well, that is that will depend on the markets. So where the virtual power plant makes most sense is where the customers are not only pure consumers or only have a PV system on their roof, but ideally also have a battery. So in Poland, the boom in the micro installations over the last couple of years has been solar only. Now more and more we have hybrid systems being deployed, but it's still a very, very small part of the installed base. If you look at the Czech Republic, B2C, essentially all installations that have been commissioned in the last couple of years have batteries. So it will depend on the market. I would say the idea is to aggregate as many energy users as possible, but of course this aggregation is quite cumbersome in the B2C segment. And I think the speed at which we will do that on a large scale really depends on how significant the addressable market is, and the value of those additional participants in the VPP. And clearly, the higher the share of installations or energy users in general that have a battery, which of course then provides significant positive impact and flexibility to the VPP, will be driving that. And so, in principle, yes, it's just a question of timing.
Okay. Question regarding the Australian projects.
So in Australian projects, well, there are essentially two. So one is our project in Boggabri that we acquired, I think at the beginning of the fourth quarter last year. So it is essentially a fully developed project. However, based on the final technical solution, that means particularly the suppliers of the battery, we had to, and we're now in the final stages of fine-tuning the grid connection conditions with the DSO. So that's something that is, I would say, very close to the finishing line. So on that basis, we expect it to be ready to build probably still within the second quarter. And the goal at this point in time is to commence construction in the third quarter of this year. So there we believe it's on track. With respect to Yadnarie, the 300 megawatt region project, we have at the moment, I think, communicated ready to build at the end of this year. And well, this is a very, very significant project, and also there the grid connection discussions with the DSO are, when you want to connect somewhere between 150 and 175 megawatt AC, are a complicated matter. So At this point in time, we're maintaining at the end of this year, but at the same time, delays can happen. So I think for us at the moment, with respect to the progress of Yadnarie, is what is important now is the commissioning of Radiant's pilot project, which has also accumulated some delays, which will however happen now because this is for us essentially the starting point for securing the project financing. Very simple, it's a new technology. If you want to get either debt investors or equity investors on board, it's just so much easier if you can show them a functioning plant. And this for us now is also the major priority. And we will provide updates on the expected technical and legal rate to build status, the timing of it, if there's a reason to do so.
Right. Next question about
yes, our targets. So the strategic targets for 2024. Whether we plan to update these targets? Short answer is yes, and it's something that we are currently working on quite intensively. And the plan is to do that in the near future. I would say at this point, I would say before the end of June, and we will announce that in well ahead of time. So time has moved on. End of 24 is near. However, there are also some significant. Also, the world has changed in 2021. Energy prices were 50 euros, and I was plain sailing. I think that this has changed fundamentally. We also see back then energy storage was an expensive add-on. Today, the economics of batteries have changed, and actually the need to integrate batteries into the grid, but also into PV plants. So actually, rather than building PV only, building hybrid plants is increasing. So these are all factors that we are taking on board. We want to. I mean, this is definitely the direction of travel, and what that means to our, I would say, immediate targets, or let's say still within the year in 24 timeline, and then beyond is something we're currently evaluating. So I think what I can say is that update will be with a timeline until year in 27, at least as far as we are projecting it now and modeling it now. And until the end of June, we were planning to publish that. Here again, I would also say that the results of our pilot project for PFAS remediation is playing a role in formulating the strategy, but also the timing of the release. How we see our company indebtedness in 3 years? Across bond issues, banks, and other sources, and the balance between the money we owe and the value of the company. Well, so first of all, I would like. So we do understand that we have heard that in the past that. Compared to other listed companies, our leverage ratio is relatively high. So clearly, one factor is that in the renewable energy sector in general, leverage ratios are high. So when you look at the project level, as the equity holder, you want to get very high leverage ratios and leverage ratios of 75-80%. In some extreme cases with feed-in tariffs, I mean, some markets even 100% was doable. So high debt level is nothing uncommon in the renewable space. So clearly there's a sector element to this. In our bonds, we have a clear covenant that our slightly adjusted, it's described in the I think in our reports, but also the prospectus of the bond, we have to maintain an equity ratio of no less than 25%. So we currently have been hovering around the 30% mark, and that's something we need to maintain. So we believe that in principle that our capital structure is okay. What is important is what I mentioned before, and I think we have taken strong action here, is that in today's environment where interest rates, well, first of all, inflation, we do expect to remain at higher levels for an extended period of time. So we don't believe in a quick and soft landing at below 2%. As a result, interest rates will reflect that. What helps, of course, is that the medium to long-term interest rates are not subject to the same volatility as the shorter end of the curve. And but there has been an increase, and of course it has a measurable impact. So we have really tightened the ship over the last 9 months in terms of making sure that all our exposure is fully hedged. Actually, also the new financing for Romania is hedged to nearly 100%. So we're not taking any risks. So definitely what we're doing is we are doing everything we can to avoid any negative surprises from our existing indebtedness. And this we believe to be a prudent approach. On the other hand, on the revenues, and here we come to the question of value versus indebtedness. Here I come back to our merchant approach. We believe that energy prices will not go back to 50 euros. We do expect it. Actually, when you look at just for the next year or two, the futures indicate a higher level than what we have been having now in the last couple of months. So Q1, but also so far Q2. So there's an expectation in the market that prices will actually go up, at least in the time frame of the next 2 years. But I think more strategically, when you look at the shift in the energy sector plus the inflation, we do believe that in nominal terms, energy prices will have an upward tendency, and therefore a PV plant, but the next phase also other assets like a battery, for example, are providing a very valuable hedge against inflation, and this is why we believe that our philosophy of basically being in a position where we can benefit from increasing prices. And what happened over the last 2 years, nobody expected. I mean, we did expect 2 years ago that the inflation would go up. Of course, we did not expect such maximum prices as last August. But the tendency we expect to be continuing, and we believe the combination of reasonably priced fixed cost debt at manageable levels versus having the ability to benefit from a long-term upward trend, and particularly in nominal terms. We're selling electricity for nominal euros, not real. So is a good combination. But this is just our asset base. Of course, we have our operating businesses where we see a lot of growth opportunities ahead, and one I would really like to point out is operations and maintenance, which is not so significant, at least so far, in terms of the contribution to the overall margin, over revenues and profitability. However, what we really do see now is a path to very significant growth over the next couple of quarters and years. As the business grows, it becomes also more efficient, and it's based on long-term contracts. So it's a bit like facility management in real estate. So small, but when you look at multiple such businesses they're actually very valuable. And across the other business lines like EPC, we see a lot of growth opportunities. DSR, at the moment, what we are seeing is the the size of that in Poland. So we're going from 7.7 this year to 25 million next year. It's the outlook that this can grow further in Poland. But then, as I said before, there's so many other markets now opening up to this. And the recent auction in Spain has seen similar prices per megawatt in years in Poland. So it is really an activity in itself that has significant growth potential in Poland alone, but has very significant growth potential in terms of new markets popping up. And the barrier to entry is actually relatively small. And also the investment would be mainly in people. So if we hypothetically entered the Spanish market, which by the way is not an announcement, but of course it is a market we're looking at very closely, then what we'll be hiring is probably a few salespeople. And if that approach doesn't work, well, we could cut down losses, which however would not be significant. But everything else, the understanding of how it works, the processes, but particularly also the software that allows us to do this efficiently, and the measurement devices we have. And so leveraging this business into other markets comes at a relatively small additional marginal investment, but with potential significant return.
All right, so last question. We get to the buyback program.
So in other words, we are happy with, we believe that when you compare value against what we owe, that this is a positive balance. But I'm not allowed to comment on our share price, so I would leave it at that. And when we're satisfied with the buyback process, and we'll complete it by the end of June. So well, we're
60% of the quantity, target quantity.
Yes.
We started in December 2022. The volumes have been higher over the past months, I mean, compared to the beginning. So I guess that's still, yeah, it's.
Yes, I think mathematically, well, maybe just to explain, we are limited to. We are not. First of all, the whole process is managed by our brokerage in Poland. So it is not us buying those shares back. It's an automated process. So based on the parameters of the share buyback program, they manage it without our involvement, and they are limited to 25% of the average daily volume of the 20 preceding trading days. So that number that can be bought back every day changes every day, as it is the average of those. So, for example, there were a few days a month ago where we had very high turnover, one day over 50,000 shares. So that has increased that daily maximum. Recently, those 50 days, those 2-3 trading days fell out of that 20-day average. So now it's a bit lower. But mathematically, yes, I think this is absolutely achievable. So on that basis, we would expect that it will get completed before the end of June, which is the long stop date for the buyback program.
All right. I'm afraid we have to close the call, but anyway, I think all questions have been answered too. Thank you very much for joining us. If you have any further questions, please feel free to reach out and drop an email at ir@photonenergy.com. Thank you very much.
We thank you for attendance. Have a nice day.